Good morning all. I'll just give it till midday just to pick up on anyone else that is joining. Can someone just drop in the Q&A box to make sure that you can see the slides and you're not just looking at my face, if that makes sense. And that you can hear me okay. Perfect. All right, so I'm going to start, and if anyone else joins, they can join us also. Thank you all for attending today. The purpose of this webinar is just to give an update on landlord taxation. And when I wrote this, I thought I'd start by going back to basics a bit, just to cover the main types of tax and sort of planning opportunities, because the landscape has changed significantly over the past 8 to 10 years or so. So to start off, just to introduce myself, my name is Carrie Stokes. I'm the director here at Spotlight Accounting. We do work with a number of landlords to help manage their portfolio taxes, and we also look at the planning opportunities and work with them along the lifeline of when they have their properties and looking at exit and future planning for inheritance of family as well. Usual disclaimer, this is intended for educational purposes. It is of general nature and it doesn't constitute legal or professional advice specific to your circumstances. You know, we always recommend, if you're going to do something significantly with your property portfolio, speak to your own accountant or an accountant. Just a bit about my background as well. We have got a property portfolio personally, so this is the reason I tend to work with quite a few landlords of a specialist nature, because we walk the walk and have a building our portfolio ourselves and understand the trials, tribulations and pains going through managing a portfolio. So the agenda for today, I'm going to just do a brief overview of the applicable UK taxes to landlords. I'm then going to go over recent tax changes, then go through a few tax planning strategies that we use with clients that are landlords in our portfolio of clients. Common pitfalls, so these are things that we come across that are errors or mistakes or misunderstandings that a lot of landlords have with regards to managing their tax affairs. And then a few case studies of how we have worked with clients over the past few years. And then I'm going to go through some next steps and give you some food for thought. So the Q&A box is open. I'm flying solo today, but if you've got any questions, I'll keep an eye on it at the end of each section and come back to your Q&A. So I'm going to start off with an overview of the applicable UK taxes to landlord clients. So firstly, income tax. So this is mainly where a landlord will hold their properties personally. In basic terms, landlords are taxed on their profit, which is the rental income less their allowable expenses. And the tax rate depends on other income that a landlord could have. Now, rental income is taxed after salaries, pension and social security and trading income. So if a landlord has partnership income and pension income, your landlord tax is applied to the next rate above, but it's taxed before savings as an investment. Now, I often use these diagrams here. So you've got two case studies of how UK tax works. If I've run through the left-hand side, between 0 and 12,570, this is your tax-free allowance, you're taxed at 0%. Between 12,570 and 50,270, this is your basic rate tax band that you're taxed at 20%. Between 50,270 and £100,000, this is what we refer to as a higher rate tax, so you pay 40% on this area here. Between 100,000 and 125,140, you pay an effective rate of 60% tax because you start losing your basic rate allowance. And above 125,140, you pay 45% income tax. The figures in brackets are the dividend rates. So if you take, for example, a landlord that might have a salary of £35,000, this is your basic rate band and your tax-free amount and your basic rate band are mainly absorbed by your salary. And then your rental income of £25,000, for example, part will be taxed at basic rate and part will be taxed as in this 40% bracket. If you, for example, have a salary of £75,000, you've gone well above that 50,270 higher rate tax threshold. So your rental income will all fall in the 40% tax bracket. So the purpose of these diagrams is just to show that depending on the level of your other income, that depends on what rate of tax you pay on your property profits. A bit of a sort of like refresher on the allowable expenses from an income tax point of view. For landlords that operate AST, so these are your standard let agreements. You obviously can allow all the costs of your repairs and maintenance. One big grey area is improvements. So the example I use is if you have a property and the kitchen comes to the end of its life and you need to replace it, providing you're replacing it like for like, that's an allowable expense. If you knock out a wall and extend the property and double the size of your kitchen, that isn't an allowable cost against your profits because it's what HMRC determine as capital in nature. You can allow your insurance, your letting agent's fees, utilities on the property when it's empty, travel to your let property for repairs and inspection. So if you manage the property portfolio yourself and you're travelling to and from those properties for inspection, or you have to go and repair it, you can claim the mileage. And accountancy fees. These are the common examples of allowable expenses for income tax. The big thing that has come recently is your mortgage interest. Instead of that being an expense, you get a 20% tax credit. So if you roll back to the diagrams I did earlier, the landlord that's earning £70,000 a year, he'd be paying 40% tax on his income less his expenses, but then only getting 20% mortgage interest relief on his finance costs. If you hold your properties within a limited company, this is sometimes referred to as an SPV. An SPV stands for Special Purpose Vehicle, and that's basically a limited company that's holding property. An SPV has to have specific SIC codes, that's the standard industry classification for buying and letting of own real estate. Mortgage interest is an allowable expense, so this is why it's often, in most cases, more tax beneficial to hold it through a limited company. And your corporation tax rate is anywhere between 19 and 25%. If your property portfolio profit is below £50,000, you pay 19% profit. If it's over 19% tax on the profit. If it's over 25%, if it's over £150,000, you pay 25% tax on the profit. Stamp duty, land tax. This is payable when you purchase a property. The additional rate is now 5% for second properties. So again, as most landlords will have a property they live in themselves, when they're buying additional property, there is that 5% surcharge. Capital gains tax. So this is payable when you sell a property. It's taxed on the profit made. So that's the difference between what you purchased the property for and what you sold it. You can deduct capital expenditures where you have improved it, and you can also deduct the buying and selling fees, so the solicitor's fees, estate agents fees and stamp duty. If you've lived in a property at a point in time, there is principal private residence relief, but that only applies to the part of the gain when you lived in the property. And the rate of capital gains is at 18 or 24% depending on other income. You have to report and pay any capital gains tax to HMRC within 60 days of exchange and completion. That has been in for a couple of years now. If you are gifting a property to a child, there is anti-avoidance rules that you have to pay the capital gains based on the market value of that property. So again, looking at my little diagram before, if a landlord had a salary of £15,000, rental income of £25,000 and a capital gain of £30,000, part of the gain would be payable at 18% and part of the gain would be payable at 24%. Inheritance tax. If you own your own home, there is £175,000 additional allowance. Buy-to-let property does form part of the taxable estate on death. And an SPV, the special purpose vehicle, that, because it's a property company, doesn't apply for business asset relief, so that will form part of the estate. So, for example, if you have 3 properties with an average price of £295,000 and no borrowings on that property, the inheritance tax bill on death could be up to £354,000. This is something that often gets overlooked or the opportunities missed. So where you've got an AST property, there's no VAT charge and no VAT recovered. What I would call the standard rental agreement is what is known as an exempt supply. It's outside the scope of VAT. If you own furnished holiday lettings, this is a standard supply. So if your income from furnished holiday lettings is over £90,000 a year, and you have to look on a rolling 12 months basis, you do have to register for VAT, and you could end up in a situation where you could lose 1/6 of your profit to VAT. If you're husband and wife, HMRC automatically deems that those properties are jointly owned. So you just need to be careful that if you've got £90,000 worth of income from furnished holiday lettings, HMRC don't deem that to be a partnership, and you could end up having to register for VAT. Commercial property, these are exempt unless there is what is known as an option to tax. And if you put an option to tax on a property, you can charge VAT to your tenants and recover the cost of the VAT on repairs and other expenses in relation to that property. Now, this again can be judged on a property by property portfolio. So if you've got a large commercial property that you rent out to tenants who are all VAT registered businesses, it would be worthwhile potentially reviewing whether you could VAT register and you can recover the VAT on all your costs in relation to that property. However, we've got clients that have got trading estates with small rental units on. Those clients aren't tenants aren't VAT registered, so it would actually be an additional cost to them to have the VAT charge on their rent, so they've chosen not to VAT register those properties. It's always worth checking just to make sure you're in the most tax beneficial position. Recent tax changes that have come into effect. Section 24 has been the biggest over the past few years, which is what I mentioned earlier about restricting mortgage interest relief to 20%. The main impact has been on higher tax rate payers, but it has pushed a lot of basic rate taxpayers into higher rate. The increase in bank interest rates and a lot of rents have been reviewed over the last 12 months, so landlords are receiving a lot more rent for their properties. This has actually worsened the position for a lot of landlords in Section 24 because it's pushing more rent into the 40% and you're getting more interest at the 20%. So just as the other thing as well is this Section 24 applies to furnished holiday lets from the 6th of April 2025. So at the moment, with furnished holiday lets, interest charges are deducted at the same rate of tax on your profit. From April 2025, you will only receive 20% relief. So just as an idea of, just to give an example of the impact on Section 24, Pre-Section 24, we've got a client that receives 28,800 rent a year. There was 2,764.80 of rental fees, £500 insurance, repairs of 1,750, £330 accountancy fees, and they had loan interest of 14,400. So the profit on their rental income was 9,055. So if we go back to where the tax bandings were before, that all hit in this 20% tax bracket. After the impact of Section 24, the profit was 23,455. Sorry, that rental income should say 23,000. But what you can see from the diagram is it's pushed the rental income into the 40% tax bracket. You then only get 20% interest on this 14,400 loan interest. So you've got a disparity in the tax rates you're paying on your property income. Making tax digital. Now, HMRC have been talking about making tax digital for a number of years. It's been pushed and pushed and pushed, but it is applying from income tax. The requirements to making tax digital is that you keep digital records, and you have to submit to HMRC quarterly using compatible software. From April 2026, it applies to landlords with rental income over £50,000. And then from April 2027, it applies to landlords with rental income over £30,000. So at the moment where you can complete your tax return once a year, and it has to be submitted by the 31st of January following the tax year, that will change. From April 2026, you will have to make a submission to HMRC if you've got rental income over £50,000 in by the end of July, October, January and April. And then from 2027, if you've got rental income over £30,000. The plan is to bring all landlords under making tax digital, but they haven't given exact dates yet. The idea with this, I'm not quite sure what the point's for, is to plan early. So, you know it's coming into effect. You need to look at how you're keeping your accounts and your records. Records, so you've got a plan of action of how you're going to get that information quarterly to HMRC from these dates. The point with before management charges are deducted, that is, it is on your rental income. So if you've got a letting agent that manages your property, and say, for example, the rent is £625 a month, but they deduct £100 management charges, you need to make sure that your £50,000 is the actual rent you receive. So you've got to add back any management charges when working out whether you fall under making tax digital or not. One thing that we will be working with on clients before this is introduced is zero offer a cash book. That basically your bank statements import, and you can use that as a method to submit the information to HMRC, and it's a cost-effective option. Furnished holiday let changes. So the furnished holiday let scheme is being abolished from April 2025. Now at the moment you can deduct interest and you get capital allowances on the furniture and fixings that you spend when you start your furnished holiday letting property. Section 24 is going to apply, so you only get 20% tax credit on your interest. And domestic items relief replaces capital allowances. So to put that into plain English, at the moment, if you bought a property that you were doing up as a holiday let, when you furnish it with beds, equipment, for other furniture, you can get capital allowances in the year that you rent the property out, whereas moving forward you'll only get relief when you replace those items. The initial sort of spend you won't get tax relief on. So what tax planning strategies are there to sort of navigate the UK tax landscape? The first one is, and it's a really simple one that often gets overlooked, is to utilise your spouse's basic rate tax band. And that is if you have one spouse that earns more money than the other and is going into the 40% tax band, you can transfer properties between spouses, what's known as nil gain, nil loss. So there won't be any capital gains to pay. It can be done through a declaration of trust. You have to submit a form with HMRC when you do it through a declaration of trust, and you have to register the trust with HMRC now, but you can't backdate it. So if you look at the example of the landlord we used earlier, he had salaries of £70,000 and rental income of £25,000 that was hitting in this higher rate tax band. If his wife earned £25,000, he could move his rental income into the properties over to her through a declaration of trust and utilise her 20% tax threshold. The next option, which is something we do a lot with clients, is moving the portfolio into a special purpose vehicle. The reason for doing that is there's no section 24, so you get interest on the relief for the mortgage interest at the same rate as you're being taxed on the rental income less expenses. There are lower corporation tax depending on your income. So if you're a higher rate taxpayer, the corporation tax rates will be lower than the personal tax rates. There are tax costs to move, that being capital gains tax and stamp duty. Because in most cases the SPV is a connected company, you cannot gift the properties into the company without paying these taxes. They have to be assessed at market value. An SPV gives flexible profit extraction. You only personally pay tax on the money that you take out of the SPV. So if you're looking to build a property portfolio, you can leave the profits in the company and then use that to build up for acquisition. And there are inheritance tax planning opportunities within an SPV, more than if you own the properties personally. There are things like freezer shares, growth shares that can be put in place that you can start introducing the next generation. This is sometimes referred to as a family investment company. Incorporation relief. So there is a lot in the press, and we work on it with clients, about moving properties into a limited company free of capital gains tax and stamp duty. And this is where you transfer a trading property partnership. It's got to be a registered trading property partnership with HMRC. It's exempt from stamp duty, and the capital gain is rolled across against the base cost of the shares. Now, with most landlords, you're looking to build and retain, so this isn't normally an issue because the capital gain isn't normally triggered. It's subject to strict criteria. It has been a tried and tested case at court. There is the Ramsey case, which they won. And the biggest thing within this, in the case, and the reason that they won, was because they could demonstrate that they worked over 20 hours within the partnership. So if you've got a full-time job and you have the properties managed, it is really difficult to prove that you will qualify for incorporation relief and this tax efficient way of incorporation. There are accountants that advertise an LLP route with corporate partners. HMRC have declared this recently as a tax avoidance scheme. So if you use this scheme, it has to be disclosed on your return. We don't get involved with that sort of thing. We just tend to stick with the Ramsey case, which has gone through court and has won, so it's in tax law. So what do you need to consider before looking at moving your property portfolio over to a limited company? Firstly, the profits of the property business. If your property business only makes £10,000 and you've got a spouse or you've got available basic rate tax band that covers that amount, it isn't worth moving it over to an SPV. If you're looking to grow the property portfolio, then it needs to be assessed as to what the long-term strategy is. Any other income you might have, again, that is which tax banding the income falls into. and the value of the property portfolio. The more value in the property portfolio, the more capital gains you might have to pay. Tax reliefs that might be available for your personal circumstances. So you might have capital losses brought forward that you could use. The original purchase price of the property portfolio. So if it is an old standing property portfolio, it is more than likely, and if you don't qualify for incorporation relief, you're going to trigger some quite large capital gains. The costs involved with transferring a property over into an SPV. There's legal fees, professional fees, you've got mortgage broker fees if you've got borrowing on those properties. The ongoing costs of running a limited company. So not only do you have to pay more in accountancy fees, most limited company banks charge for the account, and also SPVs, limited companies, tend to have higher interest rates with lenders than personal landlords. The other thing you need to consider if there's any personal use of the property, the limited company is a separate legal entity to you. So you are the director and shareholder, so you almost parent it, but those properties are owned by the limited company. So if you've got a furnished holiday let, for example, and you move it into an SPV, if you're staying in that property and use it for holidays, you could be taxed on that use because it's got a separate legal owner to you as an individual. Likewise, if you've got a normal residential property and it's something you're looking into retire into, you know, property that you could downsize into, if it's within a limited company, you're going to end up having to pay rent for it because it's not in your name, it's in that separate legal entity. Also, future plans. So we've got landlords that are looking to retain when they retire, so they want to hand over that portfolio to the next generation. We've also got landlords whose children just have got no interest in managing a property portfolio, and if that's the case and you're looking to crystallise the value of your property portfolio over a period of time, so it might be selling over a period of time as an option, an SPV might not be suitable for you. So long-term planning, what do you need to consider? Firstly, before making any decisions as to what legal entity needs to own the property and where it sits, it's the size of the portfolio now and the size of the portfolio in the future. So if you've got one property and you intend to stay at one property, it might be worth keeping that, owning that personally. But if your long-term plans is to build up a large portfolio, again, it might be looking at using an SPV structure from the start. Your exit plans from the portfolio. I know most landlords look to develop and grow, but again, you need to be thinking about the long-term plans. You know, okay, it might be to provide a source of retirement income for you or a passive income because you want to retire. But again, you need to be thinking, what are you going to do with these properties once it's built up? Are you going to pass it down to the next generation, or are you going to cash in on the capital value at some point? And it's important to be aware of that with movements within the property market. Obviously, at the moment, properties aren't selling or moving really fast. So again, if you are looking to exit and sell, it's triggering those gains at the right time. The profitability of the properties within the portfolio, this is a really important one to look at, because actually when we've had clients and we've gone through the property portfolio, there are some, and you know which ones they are, that don't actually make a lot of money. So again, when it's long-term planning, it's looking to whether you could leverage some cash on that property to buy something that will make more money, or looking at, you know, is this really a bad property to have in your portfolio, so do you need to get rid of it? And your ongoing personal income requirements, again, you can do a tax planning exercise to mitigate inheritance tax by passing on to your sons and your daughters, but it's pretty pointless doing that if you've got an ongoing income requirement from that portfolio. And understanding that is important as well, because it might be that you could look at moving part over. So what are the common pitfalls? So these are common things that are misunderstandings that we come across when dealing with landlord clients. Firstly, not declaring property income because they're unaware of Section 24. So you may rent out a property for £6,000 and have mortgage interest of £6,000, and you don't have to declare that or make a tax return to HMRC. Unfortunately, because mortgage interest is treated as a tax credit, you do have to complete a tax return and you do have to declare it to HMRC. There is an ongoing Let Property campaign that HMRC is running to bring all your tax affairs up to date. Part of this Let Property campaign is nudge letters have been going out to landlords. I swear on the land registry, someone might have 2 properties registered to their name and they're not declaring rental income on their tax return. HMRC are writing to prospective landlords to make sure their tax has been brought up to date. So if you are in a situation where you have had rental income and you're not sure whether you should declare it, there is an opportunity to declare it before HMRC comes knocking at the door. Claiming the full mortgage payment instead of the interest element. So for those that are on a repayment mortgage, without telling you to suck eggs, there's 2 parts of the payment. One is the interest that's been charged on the loan, and the second part is paying back the loan. It is only the interest element that's an allowable expense. The loan is part of the purchase price, which you get the tax relief for when you sell the property. Claiming for improvement expenditure as repairs. So, for example, if the example that I used before, if you extend a property and put an improved kitchen in, that is not a repair, that's an improvement, so that shouldn't be going on your tax return as an expense. Putting income through an SPV without transferring the legal ownership. So we have situations where clients have come, they've created a property company. The mortgage and the property is in their own personal names, but they've been trying to put it through a limited company. To put property through a limited company, it needs to be transferred properly with a solicitor. This does come to bite landlords on the backside, so to speak, when they come to remortgage properties, because there isn't a tax return showing the right level of income on, and then it often provides difficulties with getting a mortgage. The other common pitfall when disposing of a property that you've lived in is not time apportioning your principal private residence relief. So, for example, if you had a property that you lived in and you moved up the ladder, as you do, and then moved out, rented it for 15, 20 years, a common question we get was, well, if I move in, do I get, because I live in it at the time, I'll get principal private residence relief. You've got to think of this as a timeline. You only get one property for principal private residence relief. You can elect to have a different property, but if you have only lived in a property for 5 years out of the 20 years ownership, you only get a quarter of the gain for principal private residence relief, not the full gain. So next, I just want to run through a few case studies that we have worked with clients. So if we look at a small landlord client that we had, this is who I referred to earlier. He'd got a salary of £20,000 and rental income of £25,000, and it was all hitting in this 40% tax bracket. First question we asked was, what was your wife's salary and what's your wife's earning? And it was £25,000. At this point in time, the annual tax was £7,202 on the property income. We worked with them to complete a declaration of trust to move all the rental income over to his wife, and the post-move tax was £2,161 per year, so it's a saving of over £5,000 per year tax. The next example is a portfolio landlord that we work with. They had a number of properties, husband and wife, that they were operating personally. We registered a partnership with HMRC. We then took that partnership and moved it into a specialist purpose vehicle. The annual tax saving on this was £15,529 a year. There are strict criteria and a specific process that we have to go through. It can be quite a painful process to go through, but it can give significant tax savings. Inheritance tax planning. So we had a father and mother who were looking to retire. They'd got a portfolio value of £1.9 million. And what we did was we triggered the capital gain to move into an SPV that was owned by their children. The capital gains tax and stamp duty was £261,000, and that was against £773,000 worth of inheritance tax. Because this was considered a gift, the only issue you have is your 7-year clock risks. If you make a gift above the exemptions, which a £1.9 million portfolio value is, if you pass away within the first 4 years, you run the risk of having double taxation. After 4 years, it starts triggering, and after it starts tapering down the percentage of tax you pay. But after 7 years, there is no, the SPV does not form part of your estate for inheritance tax. This gift doesn't. So again, part of the example with this one is to think early about what your long-term plans with the property portfolio is. We have some sad situations where unfortunately clients come to us when it's too late to do anything with it. So next steps with all this. Conduct a property portfolio tax review. That's looking at the your property portfolio as it is, the values, the rental income, what the potential capital gains tax is, and what the long-term plans are with that property portfolio. Every portfolio is different, so we give every client an almost different answer as to the right structure for their property portfolio and for the long-term plans. You know, even just having a property that's portfolio that's highly geared will have a different answer to one that has no borrowing on. Understand the profit per tax per property. You need to understand the returns that you're getting on your properties within your portfolio. And most landlords, when they do this, they can really identify the ones that just aren't generating the right amount of income for them. Now, it's not just on an income side of things. You know, some landlords are prepared to take a lower level of income on their property, a lower return on their property, because there's a big capital appreciation in the area that property is. That's all well and good, providing you can crystallise on that capital appreciation at some point in time. Review the ownership structure. So, you know, are the properties sitting in the right legal entity? You know, is there a more tax efficient way that these properties could be structured? And to ensure that the structure is in alignment with future plans. Again, conversations I've had recently is, you know, portfolio landlord that wanted to move everything over to an SPV and sort of like get his children involved. And, you know, we'd said, have you spoken to the children? Do they want a property portfolio? And in the end, after the conversation that they'd had, no. And it was looking at an exit plan rather than a build. Again, if you are looking at building your portfolio, starting in the early stages, you know, what is your long-term plan? Are you looking to have 1 or 2 properties? Because again, an SPV might not be the right solution for that long term. Or are you looking to build up a huge portfolio? And if you are, okay, for the first couple of properties, the SPV might be the more expensive structure, but it matches your long-term plans and it doesn't give you a headache further down the line. And again, with the SPV, because it's a limited company, you can have different ownership structures. So it's again getting the right ownership structure in place that works for you and your family. Preparing for making tax digital. So, you know, £30,000 is not a high level of income as rents have been increasing over the past few years. So if it's not coming into effect from April 2026, it'll be coming through into April 2027. And okay, that's nearly 2.5 years away, but it's worth considering it and knowing it's coming and thinking about how you're keeping your records to make sure that you are compliant. that is all that I wanted to cover today. Has anybody got any questions or anything they feel I've not covered? If you have, just drop it in the chat. No? Okay.
Yeah, I dropped something in the chat. I don't know whether you can see it.
Oh, hang on, let me have a look. Hang on.
You've partially answered it, but I think really it's assigning a deed of assignment is what.
Can I assign the income to a company split? Right. So if the sorry, Stuart, I hadn't seen it. Sorry.
No worries.
So if the property is in your name, personally, to move it to a company, you've got to do it.
I don't want to move it to a company. I just simply want the income split
between you. So what you need to do to split the income, the process is to get a declaration of trust completed by a solicitor, and then you do need, there's a form that needs to go to HMRC to let them know that it's under a different ownership structure. You can't backdate it. It has to be done from the date of the declaration of trust, and the solicitor also needs to register that with HMRC through a different form. So that can all be done. If you went to a solicitor, it can be done from next week, if that makes sense.
Yeah. Does he need to tell it to the lender?
No, the only thing you need to do is the lender might want to have a look when you remortgage, because they will see that not both of the incomes are on there. But you don't have to tell the lender at the time the declaration of trust has gone through, unless it's within the terms and conditions that you have to have all interested parties noted.
Okay, thank you.
Okay, no worries. I saw another comment come through, but I can't see it. Hang on. No, I can't see.
Hi, it's Manish here.
Hi, Manish.
Just a quick question in regards to mortgage fees. So, when you're moving from one mortgage provider to another, there's the admin fees and the mortgage fees. Are those part of expenses that you can use?
It's part of the finance charges. So you can offset those, but it's at that tax credit rate.
Okay.
I'm afraid. Section 24 is really, really hammered on landlords, and actually it's not doing the renters any good, because obviously you're paying more tax, which means their rent goes up. So we'd got a client locally that had got a small 2-bed, and we'd worked out that he needed to rent out for a minimum of £800 a month because of Section 24, and without it, it would have been like £600 a month. So yeah, it's just a bit ridiculous now. The interest rates are coming on, but that's more political than tax. So I've seen. There was one about whether improvements, your conversations. So Huno, I think you'd put a comment about whether improvements could be put as an expense. HMRC are quite strict on those. It has to be a like-for-like expenditure if it is, and for it to be a repair. So if you have, like I said with the example of the kitchen, it has to be of a similar spec. So we had a property in Wolverhampton that we renovated, and the original kitchen I think had only got 10 units, and we replaced it for one that had got 25, and that would be classed as an improvement. So we couldn't have the offset of that as an expense against our tax. I'm just seeing if there's any. Are the rules the same? Oh, it's in the chat, sorry. Are they different if it's between an SPV and a person? No, it's the same rule. So again, if you're making improvements with an SPV, that is not an allowable expense. And again, and if you're making improvements personally, they're exactly the same. Right, so improvements prior to renting can be claimed when the property is sold. Again, this goes to the improvements and the repairs argument. So when you first start renting, you don't have a rental business. So if your first property you buy, you have to put carpets, you might have to replace the boiler, you might have to decorate and get it up to a standard for letting. Those aren't allowable expenses on the first property. But then when you have your second property or your third property, because you've already got a property business, you can claim for the expenditure that is repair nature, not stuff that is improvements. So if you have to paint it, that's a repair. So if you've got properties you already let out and you're painting your new one to let again, you can claim that. The next one, improvements prior to renting property when sold, you'll need all receipts. Yes, so if you are Andy, this is really good, really important, because I had this with a client that came in the other day. If you make improvements to the property, it's really important that you retain evidence that you made this expenditure, because if you the example of the kitchen that I used, if you don't keep the receipt for that kitchen, it's really difficult to demonstrate to HMRC that you have spent that money without the receipt or the bank statement. So I always recommend to clients that have let property, you'll have a permanent file that you've got with your completion statement and everything else. Whether you keep that electronically or you keep a manual file, any improvement expenditure put with that file, so you've got the copy receipt if and when you come to dispose of the property. Just seeing if there's any more questions. Do all receipts have to the SPV company name on the invoice? So if your letting statements so the question is, do all receipts have to have the SPV company name on the invoice? Your letting agent statements, 100%, you need to contact your letting agent to let them know that it is the limited company SPV that is renting it out. Obviously, if you go to B&Q and you buy a tap, it doesn't have to be. And again, with juice and big bills, like if you're having a kitchen as well or a big repair, I would expect that to be in the SPV company name. If it is in your personal name, it's not the end of the world, because it's not a VAT. If you're not VAT registered, you don't have to do it for VAT purposes. But always make sure that you're making any payments for repairs and expenditure out of the SPV limited company bank account and not personally, because it just gives an ironclad audit trail for HMRC. I'm just seeing if there's any more questions that I haven't covered on the chat and the Q&A. I think that's it. Is there anything else that I haven't covered that anyone else haven't answered? No. I hope you found that as a useful overview. I know some of it is going back to basics, but I think with all the changes of Section 24 and making tax digital, it's just sometimes important to go back to the core mechanics. Who know the best way to transfer to an SPV? It depends on your property portfolio size, whether you're married, timing of when your mortgage rates are up. So, for example, if you've got properties that are in a fixed rate for another 3 years, if you moved over to an SPV today, you're going to have a get out of jail charge on your mortgage. It also depends on the tax you'll save, because sometimes it's cheaper to pay the get out of jail on your mortgage than it is to pay the tax. So it's one of those things, because it just all depends on the size of your portfolio, the level of the capital gain and the income tax that you're paying and the corporation tax saving against it. I'll just give it another minute for any questions. No, so thank you for sparing your time and listening to me. I hope it's been useful. The contact details on the page there, if you want to get in touch with us or have any further questions. And I hope you found it useful. Oh, there's one more comment coming through and I'll just hang on for it. No worries. Thank you. Thanks. Goodbye all. Thank you.